Justin. It's good to see you again after Nashville and Alloy Labs.
Good to see you as well. Thanks for inviting me. I really appreciate it.
Well, I was so excited to touch base with you. I do this series about important cases going on in the banking space. And when I first imagined this series, I was imagining, something like a Marquette or Humphrey's Executor or Four Corners,
Yeah,
these kind of
yeah.
cases that have reached the Supreme Court. And then we built entire, basically regulations around it. But you talked to me about kind of a case that's being litigated now, and it's between two parties, and it is called Payward Interactive versus Etana Custody Limited. Can you tell me about the parties in this case and what they do and how they work together or work against each other?
Yeah, so it's a little bit different, and I kind of suggested this for a different reason, right? It
Okay.
it it isn't something like, we always focus on Supreme Court cases and their impact on, like you said, regulation or the larger marketplace. This was more of a Nostradamus type case. It's very more prophetic, right? And it highlights a lot, I think, of the issues that you're going to see kind of in different areas. And so it's not some, learned hand, beautiful, kind of opinion. It's more of this is what can happen when things don't go right. Right. So it's more important in that way. But it involves two parties.
Okay.
The first is um, it's basically Kraken, right? It's a digital asset exchange. Nobody knows the parent company, so ignore that. So think Kraken versus Etana.
Payward is Kraken. Yeah.
Payward is Kraken, right? And there's a number of different entities that are involved, but let's just think of it as Kraken. That's the best way to think about it. Kraken, if you don't know, the digital asset space has been around a long time, actually now, since 2011. They got about, I think it's like 15 million users
Okay.
over the course of time. They do about $200 billion in quarterly trading. They're big, right? They win awards. They're well known. Lots of big U.S. presence. They've been around a long time. They're actually a regulated entity.
Okay.
They've traditionally held a number of state money transmitter licenses, and then recently they were approved for a national bank charter, right? So that's not relevant exactly. It'll be relevant atmospherically to the complaint and why I think it's so important for other regulated entities. But during the course of the subject matter of this complaint, they weren't a bank. So let's not think
Right.
about it that way.
Right.
But they're going to be. So that's very interesting.
Now they have the skinny master account, the probational skinny master account.
That's right. Right. And that's
Also not
also
really relevant to this case right now, to the facts of the case, but
not to the
interesting
facts of the
information.
case,
Yeah.
but it is interesting to when we look at when we get a lot of digital asset or fintech people that want a master account and what that
Sure.
entails, right?
Hmm.
And in fact, though they have it or though they've been approved for it, that might not be the best case to look at when we look at what whether you should give those or whether the Fed should give those willy nilly.
Yeah.
Willy nilly is the wrong word, but you get what I mean. Whether they should be given and whether we should trust these people, because ultimately this is all about trust. Digital
Mhm.
assets and regulated entities, this is a question of trust. And we're going to look at where that goes. Now, there is another regulated entity here, and
Okay.
that's the defendant. That's Etana, right?
Yes.
Etana is or was, they no longer, and we'll get into that. They were a Colorado non-depository trust company. Um, Pejoratively, people will call them bank like. They're not a bank. They don't operate like a bank. They're a trust company. That's very different. But they were doing a service for Kraken here, but they're the other party,
Okay.
right? So they're both a service provider and a trust company. That's their role here.
Okay. I have written a little bit about the National Crypto Trust banks because we had a series of applications and then the awarding of those applications last year. And at the time, I was reflecting on my experience as a bank reporter because there are trust banks. There are three very large ones: Bank of New York, State Street, and Northern Trust. And I remember when I was at SNL Financial, they would report earnings, and they were large by assets, but we kind of the whole mentality was like, oh, you don't have to pay attention to them because they're the weirdo trust banks, and they're just big, but they're not the same really as these other banks. And so that would that's like 100% of my education about trust banks was I didn't have to cover them. I didn't have to learn about them. They are not like the normal banks. So my question for
Yeah.
you is
Yeah.
given my 15 years of experience and how little it's gotten me in this way, what does a trust company do? What powers does it have? What can't it do? And then like outside of that, why does a crypto company need a trust? I thought it was for rich people and foundations.
Well, yes. So, okay, very interesting questions to kind of unpack there. And let me make a distinction right up front. You had
Please.
kind of pointed out the trust banks. The difference is those are trust companies or trust businesses embedded within an actual bank.
Yes.
Right. Now, this
Yes.
is different. This is pure
Okay.
trust business based on a trust charter, non-depository trust charter. And why am I stressing that? Well, the business is the same, okay, but they don't have all the other things that go along with being a trust slash bank. So what does a trust do?
Mhm.
Or what does a trust business do? The short answer is they do whatever the heck you want them to do, right? They are a professional agent, a professional fiduciary, right? They hold your assets.
Mhm.
They execute on your instructions, right? That's why a lot of times people think about them as a rich person thing, right? Whether they're running a trust business themselves or, helping manage money, they're acting on behalf of you. That is
Right.
all they are. They're a professional fiduciary. In fact, most trust statutes will specifically say a trust business is one that engages in fiduciary obligations, right? I act on your behalf and only on your behalf, right? That's what a trust company does and is. Now, it's interesting. This is a Colorado non-depository trust. So right there in the way I described it, right? They can't take deposits. They are not a bank. They can't hold your. You say, well, I'm giving them my money. Where's it going? It's being held at a bank, just not their bank, right? They need a bank partner. Etana, need a bank partner because they cannot hold deposits. They cannot loan, well, they can loan money if you tell them to loan money, but they can't act like a bank, right? We do not operate on that same business kind of approach, take deposits in, loan money out,
Mhm.
right? That's not how they work, right? They are being paid a fee to manage something for you. You said, what are they doing here? It's kind of, why would you need a trust company? Well,
Yeah.
yeah, and keep in mind that, you know, predominantly predominantly here, they're solving a problem for Kraken. And this relationship went back to 2018. It wasn't, new.
Yeah.
Okay. This has been going on for a while. And what the trust company, the problem they were solving was 24/7 settlement, right? So what they would do is customers of Kraken essentially would become
Mhm.
customers of Etana in theory, and they would have money on hand at Etana that Etana could manage and push across to Kraken whenever Kraken needed at any time of the day to allow these customers buy digital assets.
Right.
That was the solve, right? And because Kraken couldn't,
Yeah,
and
because Kraken's
really
not a trust, so Kraken can't
can't
hold the customer funds. It's
funds,
gotta put them
can't
somewhere
can't
else.
act on their behalf. They
Yep.
needed an intermediary to do it. Okay. Now, that's actually not where the real problem comes from here. It doesn't come from that in particular, but we'll get into that. But that's who they are and what they were
Okay.
doing here.
And that's why and when we talked about this, the relationship between Kraken and Etana kind of comes out because crypto companies and exchanges in general are difficult companies for banks, like depository financial institutions to service.
Yeah.
And I think you had said, Etana maybe isn't the best in the biz per se, but Etana is a good service provider because Kraken can rely on them to maintain this financial relationship. And it would be very disruptive if Kraken was using a different firm and the firm was like, you know what? You guys are moving a lot of money around. We don't always know who this end customer is. We don't know like what, crypto is purchased for. So it's just probably easier if we don't bank you. And that's kind of, I think, some of the broader debanking that we've seen or crypto has complained about, right?
Yeah. It's tricky, right? And first, let me kind of clarify. I don't represent Kraken or Etana, and I know a lot about Kraken because they've been around a long time. I know very little about Etana other than what's in the complaint, and these
Yes.
are all allegations. So I'm making some inferences here that may not be based in fact. So again, lawyer, I cover my own butt.
Yeah.
That's what I do for a living. So I wanted to clarify that. But with that said, kind of, yes, I think in the debanking space, and I can't speak to why Kraken thought Etana was the right fit, but you do get, and historically you have gotten, and I've represented both bank and fintech and crypto company on these issues. You do get a lot of churn, right?
Mhm.
Because the risks posed by a digital asset related company are different than a traditional customer, right? They tend
Right.
to have more payments. They tend to have more regulation and regulatory interest in what they're doing. There's more risk involved. Money moves faster oftentimes in this space, right? They're tricky, and this goes way back. During the crypto boom of the mid 2000s, right? You had somebody like Coinbase, right?
Yeah.
Similar in what they do to Kraken, and they had bank partners to hold funds, US dollars and other, fiat currencies, to allow customers to be able to purchase, much like Etana would do. And everything's fine and dandy, except for you have to onboard those customers. And that's fine when you're onboarding 100 people a week. And when there was a big boom, it goes up to 30,000 customers, a month. It becomes kind of hard to do that,
Sure.
right? So, some of that makes it tricky. It's always been tricky. And I think you see a lot of, is the juice worth the squeeze? And some
Right.
banks have said basically it's not. And
Yeah.
so you say, well, why is Etana there? Well, Etana already has the banking relationships. They're another trusted intermediary. They have a non-depository trust license. You're not banking Kraken
Kraken.
necessarily. You're
Yeah.
banking them.
You're
Now,
banking
does that
Etana. Yep.
matter? Yeah, sometimes
It
it
might
does,
matter.
but it makes it a little bit easier,
Yeah.
okay? At least from
Yeah.
the bank perspective.
Right.
Now, does that mean that we throw the steering wheel out the window? No, but it's a little bit more sellable, so to speak.
Sure. Okay. So you said this relationship starts in 2018. Kraken is a very big established like legacy. It's practically like a senior citizen in the crypto space from 2011. What happens in April 2025 when Kraken went to make a withdrawal of $25 million of its funds
It's fun.
from
Yeah.
Etana, from its Etana accounts?
And this is really what's interesting, right? It wasn't, Kraken didn't come in April and say, hey, my customers want to buy 25 million of Kraken stuff. No, 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 no. Kraken had, I think it was a couple years prior, had put in, I want to say it was like 2022. They had talked to Etana. Etana said, hey, you know, we love charging you money for this service and getting paid, but it would be also cool for both of us if you just deposited a bunch of money with us, and that would help us. And then we could just not charge you either as much or anything for the service we provide you. And
Okay.
Kraken said, hey, great deal. So Kraken put in, and every bank will know what this is, or any program bank would know what this is. Kraken deposited $25 million into a reserve account
Okay.
with Etana. Okay. This is Kraken's money, not its customers' money. This is
Yeah, it's like their
Kraken's,
operating funds,
their
their
money. Now,
capital, whatever. Yeah. Okay.
right. And so let's fast forward a few years, right? So the relationship starts in 2018. We add a reserve component in 2022. Now it's 2025. Kraken comes to Etana and says, hey, I need my money. I need my money out. Give me my $25 million. Etana says, uh-oh, right? And they don't say it right away. Eventually what they say is, we don't have it. But
No.
first they say, well, we need to do a reconciliation. It's not reconciling. They delay. They play a game of delay. They
Okay.
also do things like, they at one point, I think in the complaint, this is alleged, so but I have no reason to doubt it. They say, we already paid you that 25 million. Don't you
No, they
remember?
didn't.
Yeah. But the short answer is they don't have it. They
Great.
don't have it. And so all of this is happening kind of simultaneously with, adverse regulatory actions vis-a-vis Etana.
Hmm.
And this kind of comes to a boil real fast. But basically, Etana tells Kraken more or less, we don't have your money, so we can't give it back to you. And by the way, would you loan us a few $1,000,000 because our regulator is requiring us to up our capital reserve for our own bank? So, if you want your 25 million back, this sounds like one of those overseas scams, right? I
Yeah.
need more
This
money
is
from
pig
you
butchering.
to
Yes.
fix this. Now, to their credit, Kraken said, hard pass on
Yeah.
giving you more money, right? And then shortly thereafter, Etana gets a cease and desist from their regulator, the Colorado Department of Banking. They are not able to operate, and summarily Kraken sues, which is
Okay.
what they should have done.
Okay. Let's go back. Is it normal and good, like that a non-depository trust would lose its customer's reserve account?
Probably more normal than it should be, especially in the digital asset space. Is it normal? It shouldn't be,
Right.
right? Because remember, a trust only does something that its client tells them to do.
Yeah.
So the thing that was weird about this case is you would say, well, what did Kraken tell him to do? Now, if Kraken said to Etana, hey, here's $25 million, I want you to invest it in 10-year, treasury
Yeah.
bill, right? Like, okay, the money's not liquid because you told us to put it in T-bills, right? Fair. That's fair, right? But that's not what was happening here,
Mm-hmm.
right? They didn't say, play with my money and put it in instruments that are
Yeah.
tied up for a long
It
time.
wasn't like an investment account. It was a
Yeah.
reserve account.
It was a reserve account. They said, hold my money.
Yeah. Put it somewhere. Put it
So you
somewhere.
aren't holding my money. You
Yeah.
didn't do what I told you to do.
Sure.
Your job was specifically to hold it. You did not hold it, or you
Yeah.
did something with it, and I don't know. That was the problem.
Yeah.
And so it shouldn't be the case. And more traditional, and there's digital asset companies that operate in the trust space is kind of a trend, but there's many trust businesses, there's many non-depository trust companies that are completely normal and do all these
Yes.
things and do them well. But in the digital asset space, this has happened a few times. In the digital asset space, not involving trust, this has happened where customers say, here's my money, and then the money isn't there.
Right.
Kind of a close-up magic problem.
So you mentioned that Kraken, April 2025, Kraken wants its money back. That's when Kraken learns the $25 million is gone / inaccessible. And also that Etana needs to shore up capital because it is separately getting pressure from the regulators. So can we talk about where is the regulator kind of in all of this? What are the regulator's jobs or duties? If it's not to just open the accounts and be like, yep, $25 million is right there where your customer wanted it. And then what happens to Etana after the regulator tells them to raise capital?
Yeah. So let's break that down, right? Where is the regulator, and then what happens here?
Yeah.
The regulator is there. Colorado Department of Banking is there. I don't know what their examination history is,
Okay.
but remember, this is the Colorado Department of Banking or Division of Banking. I can't remember if it's division or department. It matters little to me. It's the Colorado
state regulator.
Banking.
Yeah.
It's the state regulator. Okay. They are the ones who granted the trust. This is a creature of Colorado law. It is administered and supervised by the Colorado state regulator. So presumably there's both an application history where they get the trust charter, and then there's a supervisory history, right? That's why you see over time the regulators start to interpose controls, right? They say, I don't know what's going on here. I don't like what I'm seeing going on here. And by the way, they were at a very low capital requirement. I think they need to have 300,000 in reserve.
They don't have to have a lot of capital because they don't lend, right?
Because they don't lend. And they don't have depository obligations, even though they hold customer funds, right? So their capital requirements are very low, which is sometimes the reason why you might have this vehicle. But they upped that from 300,000 tenfold to 3 million. And they also, I think, required a higher surety bond or whatever the other kind of, the other economics in this work. Now, that's a normal response to something that the regulator sees and doesn't like, right? Now, what exactly they're seeing, I don't know if we'll ever know. What we do know here is when they couldn't comply with that, they were put into receivership. So the Colorado Department of Banking appoints a receiver, and it basically serves like a trustee in a bankruptcy context to wind down a company that failed, in this case, a trust company.
Okay.
Yeah.
And I mean, this is not the first time I've heard of a non-depository financial company that kind of interacts with people's money that then goes into bankruptcy. And then we learn very painfully that the bankruptcy for banks is a very different and arguably smoother process for everyone, except for the people who have to close the bank, than for trust or then for non-depositories. And there is a concern about missing money. So, like, if this sounds like Synapse, there's some really strong parallels, but these are different companies, right? This is a trust
Different
company.
different entities,
Yep.
different processes, and they all
Yep.
sometimes sound the
It
same,
sounds
right?
the same. I'm sure mechanically it's different. Legally it's
Very,
different,
very different, very
but
different. And
it's
it does matter
it
here,
does.
right?
Yeah.
And it matters as to what they are and
Yeah.
what they're not. And you called out, like think about like a Silvergate, right? Or any of the other banks that have failed in recent memory.
Silvergate liquidated, it didn't fail, but go on.
Okay, sorry for the technicality. Yes, but to the extent that a bank were to fail, it would go into FDIC receivership, right? Oh, receiver. That's the same. No, it's not, right? Remember, first, a trust can't actually hold deposits. Somebody
Right.
else is holding those deposits, right? Trust can't take deposits. There's no FDIC insurance from the trust on those funds,
Right.
right? So you don't need an FDIC receiver. Second is, and this is an interesting kind of foible, right? Banks can't go bankrupt. There is no process for banks to go bankrupt. That's why they go through the FDIC receivership process. A trust company sure as heck can,
Yeah.
right? They do go bankrupt. I've been involved in some of these bankruptcies, right? So in a bankruptcy, the rules are much different, right? There is no FDIC deposit insurance. The bankruptcy rules apply, and the question becomes one of whose money is it?
Mhm.
And invariably, in some of these trust company cases, it's not always clear. There is usually extensive commingling of their funds and their clients' funds, and usually it's really hard to tell, right? Which makes it challenging because in a why FDIC deposit insurance exists is because once you deposit money at a bank, you create a debtor-creditor relationship. Yeah. And so without deposit insurance, that's the bank's money, not your money,
So the
right?
insurance almost it
It's
provides this like if, thinking about me, non-legal bank customer,
mm,
the fact that I put my money into a bank and it becomes a deposit line item entry, the existence of the insurance mechanism almost provides it as a halo of this is Kia's money. It
yes,
had and like if something happens, Kia's money is covered, but in order to have this coverage, it has to be seen as separate from the bank's money, the bank's operating funds.
right. Because so there's a weird, and you're right, it creates an effect of something that's not true in practice. In practice, that ain't your money anymore. If the bank were to be allowed to go into bankruptcy, that would be part of the estate, not part of Kia's funds.
Right,
But
but
that's why the FDIC
that's
insurance
why
is
the
there.
FDIC does what it does.
Because it
Yeah.
comes in to say, well, while that might be technically true, you're insured on the deposit you put
Right.
in, and here's the money, right?
And
That
that's why the
yeah,
uninsured deposits, they have
yeah,
they might take haircuts because the
they might.
FDIC pays out from the
Yeah,
assets of the bank.
correct. And to be fair, and let's not get into
I
bank
know.
failures and all that
This is
fun,
this is just to decide like what's different between these two.
but to be fair, right? Yes, you are limited to the FDIC deposit limits, right, by depositor across the bank, and yes, you might take a haircut. You might if you have uninsured deposits, right? And there's sweep networks, and there's all sorts of things to protect against this, but that is generally true. Although there's also the kind of the FDIC insurance fund, and basically over the last whatever, dozen bank failures, the depositors really haven't eaten it. That's a testament to how the FDIC receiver process really works. And I'm not always going to, high five the regulators on everything, but look, nobody's really uh, eaten it on a
Yeah.
depositor side lately.
Well,
But
yeah.
yeah, well,
I
yeah,
just I
yeah,
think
go
it's
ahead.
interesting too because when you and I were talking about this, it was really bringing up in my head the mechanics of a bank failure that I was familiar with. Because what is happening between Etana and Kraken is very foreign to me, in
Hmm.
part because neither of these are depository institutions, and because of the mechanics of bankruptcy itself, which I have also, as a bank reporter, do not have to think about. To your point, right?
Why would you?
Like,
Why would you? And it was interesting. I was in a bankruptcy case, and there was a old bankruptcy judge serving a role within that case who said bankruptcy can sometimes feel like a legal stick up,
yeah,
right? And there's all sorts of weird reasons why that is, but part of that deals with the priority in the waterfall of payment in a bankruptcy case, right?
Mhm.
Well, if you give money to an entity that goes bankrupt, do you get that money back? Maybe.
Depends on
Depends on,
what your creditor claim is.
and banks should be intuitively knowledgeable about that, right? Why do you take a security interest in
Right.
your underlying commercial customers?
Commercial real
Because of that
estate,
reason.
right? Yeah.
Because of that reason, because they can
Yes.
go bankrupt and they can screw you,
Yeah.
right? And you might not get repaid. That's why we do things like security interests and the like, right?
Yes.
Okay. But that's what's happening here. If money isn't yours, but it's Etana's, let's not get into the debate on what money is whose, but then it really isn't yours anymore and it could get lost. It could be subject to preference actions and all sorts of terrible things.
Mhm.
You might not get paid back. Depends on where you fall, depends on how many assets are in the estate when they, have to divvy out, right? So if the trustee or the receiver is able to collect a bunch of money, maybe you'll get some back.
Yeah.
Depends on what they did with it.
Okay. So in this case, Etana declares bankruptcy, and Kraken, I believe, separately sues for this missing money, and they make allegations of breach of contract, breach of fiduciary duty, fraud, Ponzi-like allegations. All of that's very scintillating stuff, and you should read it if you want to learn about crypto
Yeah.
shenanigans. But
Yeah.
to the point about bankruptcy, Etana, it makes what you were telling me is a really novel claim to Kraken that is related or grounded in its bankruptcy proceedings. What did Etana, can you tell me what Etana told Kraken about this missing money?
Yeah, so what they told him and then the effect of what they told him are
Yeah.
kind of different, but it's
Okay.
interesting, right? Basically, and this is in the amended complaint, and I think there's a second amended complaint as well. What they basically said is, yeah, we don't have your money. We kind of spent it. Like that's basically what they
Yeah.
say.
Great.
We used it for operational costs. We used it for our own ends. Yeah, we spent your money, right? Well, that's weird. I thought trusts were there to safeguard your money.
Sure.
Yes, there's a difference between what we're supposed to do and what we do with it. And once I give you money, if you choose to spend it, that's a problem, but you have the control of the money. Who's going to tell you no? But that's essentially what happened here. And part of what the argument is, or part of what they said is, and part of what this happens a lot, this has happened in Celsius, it's happened in Prime Trust, it's happened in other cases, is they'll say, well, I couldn't really tell you what's your money and what's my money because it's all in one big, pool, one big pot in the back, and I just took out of that pot. Right. And so is that the estate's money or is it your money? It's hard to tell. I can't even tell you whose is what. So sorry, we can't tell whose is whose. So it's going to be mine by default. That's an argument that often is made in these cases.
That's crazy.
Yeah, really. Yeah. The answer, the argument is I'm so bad at my job that I made your money mine. Close up magic.
And then I
Right.
spent it. And
And I
so,
spent it.
yes, that wasn't allowed, but also your money's gone and there's nothing you can do. And it did become my money.
Yeah. So go ahead and go after me because remember, I don't have it anymore. It's it used to pay for I don't know. I'm not saying what they did with it, but I used it on private flights to Acapulco and,
Yeah.
large Long Island iced teas or whatever it was, right? The truth is it's been entered into the world of commerce and it's no longer here for you to have. So what are you going after at that point? Yeah.
Why? Okay. As I previously established, I never had to pay attention to trust companies and separately do not understand how normal bankruptcy proceedings work because I get to cover banks and bank failures. What is a normal non-depository trust bankruptcy supposed to be like?
Yeah. So this is how it should work. Right? In theory, the money that your customers would deposit it into your bank on the custodian of isn't your money. It's not part of the estate,
Yeah.
right? Your job is to hold somebody else's money, which means there is no debtor-creditor relationship, which means it's their money. It's not part of the estate. You would have to separately take that out. So you would take all the assets, you would pay back all the depositors because, again, not the estate's money, their money.
Their money.
And then you would take whatever's left in terms of operating accounts and things that the trust actually owned and distribute it through the bankruptcy process, right? So the question is a fundamental question of what is part of the bankruptcy estate and what isn't.
Yeah.
And that's what courts have to decide. And there's a lot of reasons why they might choose one or the other, and it hasn't always been litigated. But, especially in some of those early crypto cases, which did not involve trusts, right?
Yeah.
They involved private companies. They would say, it's all kind of thrown together by these random
I can kind of
enterprises.
understand, like, in a crypto exchange, that kind of is just like one big pot of money. But for a trust, I would actually the trust is, in my mind, again, it's like just a ledger. It's just a list that you had to keep, and everyone maybe has their own ledger book. And then in a bankruptcy, you're like, well, here's all the ledgers. The last time we updated them, all the money is actually at this bank. And so you're going to, as part of the bankruptcy court, just have to go to that bank, give court orders, say, hey, this was customer A's funds. We were the intermediary of it because we were the trust company. But like now that we're in bankruptcy, because we can't manage our operations or finances, but it has nothing to do with your money because your money would have been fully separated from our money. Right? Right?
You're 100% right. And it's a very, very interesting so there's a lot of lessons that bank executives and regulated financial institutions executives should understand. One that is kind of hidden here is, and I don't know who who Etana's bank partner was, but how are those accounts structured, right? Typically, if I'm a bank that does business with a trust company or with somebody, right, I have a very tight understanding of what they're doing with that money, how they're accounting for it, how it's segregated. Typically, customer funds in these situations have to be segregated, right? So maybe you have an FBO account or some vehicle like that where, yes, Etana can manage it and move it and do whatever, but it's very clear whose money that is and who it's being held on whose
Right.
behalf, right? And what
Yeah.
you're talking about, you see this a lot with Synapse and others, is this is a question of reconciliation. How do you know, right? Especially because these tend to be omnibus accounts. It is a big bunch of money. So how do you know whose money it is? Well, you got to have we always use the words, who holds the
Subledger.
subledger?
Yep.
Right? And who is reconciling the subledger against the omnibus ledger? How often is that happening? Right? When Etana came back and said, "Oh, we can't reconcile it," that happens, right? Money comes in and out of an account, right? And it's hard to reconcile it on an ongoing basis all the time, but it can be reconciled,
Yes.
right?
It's your
Yeah.
job. I don't like what it's difficult, but like then don't be a trust company.
Well, it's
Right?
right in the name, Kiah, trust company.
I know. Okay, so to be clear, it sounds like Etana in its in its case against Kraken, not bankruptcy, is arguing that because Etana has declared bankruptcy and it's a non-depository trust, customer funds can be pulled into the bankruptcy estate as a preference claim and will be paid out in the order that the bankruptcy judge declares. Because also, it does not sound, because again, we don't have this special deposit halo, that you do not have the senior claim, right? The way that in a in a bank failure, depositors have big senior claims because of the insurance
Sure.
coverage.
Yeah, there might not be, and there could be ways to subvert priority or jump to the head of the line. There could be secured creditors of Etana. I have no idea. I haven't
But
looked
yeah,
through that
potentially.
docket.
Yeah.
But what you would be saying there is you might get some of this back or all of it back, but you got to wait and you got to get in line.
Right.
Yeah.
And also, you have to get it from us. Like, we're not just going to give it to you because the ledger says it was yours. You have to successfully convince this guy, the bankruptcy judge, one, that you had $25 million and that your claim is senior to everyone else's claim when we don't know what the secured claims are. Also, and I hate to be like this does not feel like this does not feel like how trust should operate. Like, they shouldn't be able to make this argument. If I was,
Seems
ruler of
unfair.
the world.
Seems unfair, no?
Right?
And remember what my mom always used to tell me when I would complain about the indignities that I suffered as a upper middle class youth, right? So to say not a lot, I understand,
All the hardships.
and I'm not right. I appreciate that, but life's unfair, right? And it seems like a ripoff, right? Because remember, going back to what they are, Etana that is, and what this is about, it's about trust,
It's about
right?
trust, the verb adjective, not about like the noun
Not
or
about the
whatever.
noun,
Like,
not about right. This is about the concept, and this is prominent in digital assets as well. I trusted you, right?
yeah,
Ooh, I read this book because it was Oprah's book club. I trusted Oprah. I bought this, I don't know, bread maker because Good Housekeeping gave it its seal of approval. These are indicia of trust. And what is a charter or what is a license other than a proxy for trust,
yes,
right? I trusted you because you're regulated.
right.
Did I?
Well, yeah. Okay. We are my audience, my core audience are chartered financial institutions, and they have the Magic Halo deposit insurance as well as all of the regulations and tribulations and costs that come with this. Why should chartered financial institutions care about this lawsuit and this bankruptcy between Kraken and Etana if like if it kind of doesn't directly apply to if this situation may never directly apply to them?
So there's a couple reasons. Okay. So I'll kind of march through them and
Sure.
then you tell me when you want to stop. So the first one, and this is one that I deal with a lot, right? I deal a lot in litigation and setting up the contracts too with it's a permutation of vendor oversight,
Sure.
right? Atana at its core is a vendor. They're a vendor of Kraken. Kraken was at all times a regulated FI. They were a money transmitter, and then they eventually got the national bank charter, but that was before, right? But they had a regulated counterparty, a regulated vendor that was going to do something for them,
Yeah.
right? Banks know all about this. This is regulatory oversight. This is vendor oversight 101, third party, fourth party oversight. We always
Yep.
use these fun terms, right? What happened here? Now, by the way, Kraken wasn't a bank at the time of the contracting. They might be, in the future, but not in 2018, for instance. But they're giving $25 million to these guys,
Right.
right? What would you do if you were to hire a custodial intermediary, a custodial vendor as a bank? Due diligence,
Yeah.
annual reviews,
Mhm.
ongoing monitor. I know this is what I do for a lot of my practices, program management agreements, service agreements, that sort of thing. You bake those rights in, right? And you have some form of third party risk management program and
Mhm.
approval and ongoing due diligence. But there's a difference between putting it in paper and actually doing it.
Right.
And what this shows, and Kraken, for whatever you think about Kraken, whatever you think about digital assets, Kraken is a very large, very sophisticated, very regulated financial institutions player with a lot of resources,
Right.
right? They probably have more resources than any one of my community banks, or maybe all of them combined. I don't know. I haven't looked at their balance sheet, but they have a lot of money. They have a lot of staff. They have a lot of people. And
Yeah.
anybody, not just this isn't an indictment on Kraken or anybody else, anybody can miss this if they don't have good process. This is a reminder that due diligence and oversight processes matter
Right.
because what they sued on was breach of contract. That's a cleanup remedy. And by the way, I love cleanup remedies because I litigate too, right? That's great. But that's not the situation. You don't want to be cleaning the situation up. You want to prevent it from ever happening,
Yeah. Right.
right? And that's why that's so important. And this is just another reminder that that's very important for everybody in this
Yeah.
space,
Yeah.
regardless of who is on the other side, regardless of whether they're SOC 2 compliant, regardless of whether they have a trust charter, money transmission licenses, whatever.
Mhm.
Does not matter. You gotta, there's a difference between having something on paper and proving it. And
Right.
that's what's happening here. That's a big part. Sorry. So we can keep going, but you tell me.
No,
Where do you
you keep going. I love that it's like this is a cautionary tale of
It is.
third-party vendor risk management. Like,
And you see it over and over again, right? And I actually think, again, not to high five the regulators all over the podcast, but look at what they've done with third-party oversight guidance. They've been very express on this, not just on what you should do in terms of diligence and oversight and managing it, but what you should have as contractual remedies. They've been very good about
yeah.
being proactive about that because this happens all day, every day,
Mhm.
right? How many vendors do you think a traditional financial institution has? Usually
Oh,
over 100.
hundreds.
Over 100. Any one of them, you give all these people 25 million, You're gonna be suing all of them? Oh,
Yeah.
geez. I would love it, vulturing and everything. But no, the point is that this happens all day, every day. This is a very fundamental lesson that we all sometimes miss, and we can't miss it. So
Yeah.
that's lesson one, is the primary lesson and the primary interest, I think, here. But there's other lessons, right? So we talked about one, right, which is that a trust company is not a bank,
Right.
right?
Right.
And
Powerful reminder.
if they fail, you might be in trouble. Now, some people say, I don't deal with trust companies. Okay, that's true. But how often do you put trust in an entity because of what their good housekeeping seal of approval
Yeah.
says,
We deal
right?
with a lot of non-depository financial institutions that have some sort of license, some sort of transmitter license, non-depository trust company, right? And
Hell, it could
and
be a bank,
yeah.
right? We put trust into banks because they are, oh, that's a national bank. But do you know? Well, no, because they can't tell you about what's going on in examinations. They can't tell you that. It's confidential supervisory information, right?
Mhm.
So even if your counterparties are banks, you have the same problem, right? Is you might just say, well, they're regulated just like me. Isn't that good enough? No, right?
Yeah.
Just because it's Oprah's book club doesn't mean you like the book, right? You gotta actually look, right? And I think that it's more manifest here as to, how much do we trust the regulatory process? And that's not a criticism of Colorado or anybody else. Regulators aren't always, because they can't be proactive. They can't see problems. They might be able to anticipate them,
Mhm.
but they can only react. They can't downgrade you until you have a problem. They
Yeah.
are reactionary. Whereas if your counterparty is being supervised and their supervisor is reactionary, it's usually too late.
Well,
So,
and
yeah.
the other thing too is, and this isn't a lesson per se. This is me just being a crypto cynic and catastrophizing. Is like, what's the difference between Etana and any of the companies that the OCC awarded national trust charters for? Because those do not have bank units, bank holding
Yes.
companies. So,
Mm.
and again, like I was talking about my weirdo trust banks. Well, at least they have banks. Like they're regulated by the Fed. They have access to the discount window. Well, we've seen, like what, like
Yeah.
eight
Mhm.
national trust charter. Am I supposed to say like, oh, like I'm not here to talk shit about Colorado. Is there a
No,
difference between what Colorado was doing issuing these charters and what the OCC is doing issuing these charters? So if it can happen like with this Etana, if it can happen with Prime, what is it, the Prime whatever Treasury, if these state chartered non-depository trust companies can have this kind of shenanigans in their bankruptcy, can't Anchorage or can't any of the other ones that, and like we're just going to be like, oh well, but Anchorage has been around for 5 years and we're just going to try, like we're going to trust it, we're going to use that word again, we're just going to trust that the OCC is going to get in there and check it out, or that the OCC will assign high enough capital ratios, or like, I don't know, is the OCC going to go check the reconciliation ledgers and just make sure everything balances? Like, what? To me, I'm like, I'm sorry, is this just going to happen like in a bunch of places now because we just keep giving out these charters?
there's a risk, right? And this is true of all new entrants into the chartered FI space, right? Now, I'm not
Yeah.
trying to say anything negative about Anchorage or anybody else,
No, but
or
I'm just saying
even
those
Etana.
as examples of companies that received these
But there's a
charters. Yeah.
difference, right? And this is true. I think one of the trends you see nowadays, and which is why I'm also interested in this case, is kind of what I would say a new charter holder. And Etana would be a new charter holder, or at least back in 2018 they were
Yeah.
new, right? But you see a lot of, whether it's a digital asset company or a fintech or somebody else say, hey, I want to be a bank, right? I can be a bank. Well, there's a difference between getting the charter, getting that piece of paper. It's like getting the degree and putting it up on your wall, and actually doing the work,
Yeah.
right? And so a lot of times, and this goes into an understanding of how, de novo and bank change of control processes work. You have to have business plans and you have to have paper,
Yep.
right? You've never done it before, right? So this is a plan. This is aspirational. But once you actually get that charter, you actually have to do it. And it's not as easy as it seems, right? And so you've seen this come time and time again, and not to pick on Anchorage, but they had I think it was a national trust charter, right?
Yep.
They had they had the OCC under, they had a charter and then they got pinged for BSA issues
Almost immediately. Yeah, they
almost
get their charter,
immediately.
almost immediately they go under a
Right.
consent order.
And again, not a criticism, but there's a difference between saying, I'm going to have this great BSA program and this and that, and then actually doing it.
Mhm.
Right. So the point that I'm making is it's one thing to get it, it's another to actually do it. And sometimes I think, it's almost like, did you ever hear the old joke about the pie eating contest?
No.
You know this? What do
No.
you get? What did you get when you won the pie eating contest?
A lot of pie?
More pie.
More
Yeah.
pie.
That's the win you get. So, but no, be careful what you wish for. You just might get it is kind of the
Yeah,
mantra, right? Oh, I want to be a bank. Well, do you know what being a bank is? And not picking on Colorado, it's a lot different to go through a bank examination, to do safety and soundness, to do management reviews, to do all that, than it is to go for a non-depository trust examination, right? It's be careful what you wish for, right? It's a lot different. And
right.
now you've got the regulator there all day, every day. And so, yes, fine. Everybody gets a charter. Great. I don't actually have a problem with that. As long as you know what it is that you're willing to put in the work and you're willing to kind of do the things you need to do so that you still have the charter and are in good stead 5 years from now, 10 years from
Yeah,
now. It's a long-term game. And whether that's the case with some of the new entrants is yet to be proven. It's not to say that they won't,
right.
but look, there's a difference between doing it and saying you want to do it. And that's
Yeah,
all I'm saying. And so we don't know what that's going to look like. So do you trust the new charter holder or not?
right.
It's
Well,
a lot
and
different than saying, well, they have a
do
piece of
you have
paper.
any meaningful way? Like, I think one of the other things too, and we've talked about this in this episode, is like the kind of the outsourcing, right? Like, well, I trust the OCC or I trust the Colorado Department of Financial Institutions. I trust that you guys do your job. I trust that you would have good judgment. I trust that you wouldn't have given this charter to someone who wasn't serious. So I trust you, and you trust them, or you feel like you can build trust in them, or whatever. And then but like me as the consumer, me as Kraken, maybe me as the user of Kraken, I kind of can't. I can only enact so much due diligence,
Yes.
and I just think about this like kind of chain of like outsourcing trust down the line, and then to be like, again, because I feel like I'm inherently I feel like crypto has done nothing to earn my trust overall in the 15 years. Like, why do I keep seeing these stories? And then to see oh, now you want payment accounts from the Fed.
Oh, yeah.
Now you
Yeah. With
so
this,
like Etana, and like let's pretend like before Etana declares bankruptcy, Etana could have like applied for a master account at the Fed or a payment account at the Fed. And like, is the Fed gonna check the reconciliation ledgers that it's and make sure that Etana is always acting on the fiduciary? And I just am
yeah.
like, when I say like I don't trust these players. They have done nothing to earn my trust, but we keep giving them charters and we keep being like, well, we should let them in just for like the sake of innovation. And I'm just like, wait, we have to pause. How do these companies keep declaring bankruptcy? Don't you just collect your little fees from
Yeah.
from your Kraken customers? What are you doing with this money? Like,
And I'll ask you a question, Kia. What is your read based on this case? Does this merit in favor or against giving people access to Fed accounts that have charters but have not proven it yet, right?
I,
don't have a long
I,
history.
if a company cannot reconcile its books, you don't get to exist. And so it should have been liquidated, not bankrupt. And the other thing too, and I genuinely, this, for a while, everyone kind of was talking, like Alex would talk sometimes about how we need fintech insurance for a
Yeah,
Synapse
surety.
case.
Well,
Like
we need a special surety bond when they
we need
screw up. Yeah.
special fintech insurance equal to somehow to the amount of customer funds that move through this company. And I don't know if that exists. I don't think it exists.
So it doesn't, right? So you say, well, what's the capital requirement? That's kind of like a
It's
surety.
supposed to.
It's
Yes.
supposed to
Yes.
be, right? And money transmitters have what they call surety bonds, right? Which
Yes.
is like basically an insurance policy if they screw you or screw around with customers' money, but are they well calibrated to what the actual risk is, right? Well, just Kraken had 25 million with Etana. I'm guessing that's not their only customer. I don't know what their total assets on hand was,
Right.
but for a long time they were operating with $300,000 worth of capital,
Insane. What crazy.
right?
Yeah.
So how do you scale that risk? Now, you might say, okay, well, what are you guys talking about? Well, there is a way to scale it in the bank space, right? These are the permutation of things like what Kraken was using, reserve accounts and things like that, but they go the other way, right? So how do I protect against that? Well, I I protect against it by making my vendor have a reserve account. So when they screw up and they
Yeah.
owe me money, I
Yeah.
just take it out of their account,
I just
right?
debit it. Yeah.
That's a great security measure. That's essentially an
Yeah.
informal way to get at it. But surety bonds are supposed to do that. They just rarely, are
Yeah.
kept that way. That's the idea conceptually, is to protect against outsized harm. But this is why I oftentimes preach maybe a little bit too much about kind of the need for dynamic reserves, because relationships evolve over time, and the reserve should be calibrated to what the actual risk is, not
Yeah.
some theoretical risk,
I
right?
think in the
So,
absence of
yeah,
insurance or something that kind of functions in that way, that makes sense. And I don't know this. If they had dynamic reserve accounts, would that mean that I think everyone should get a payment account? I still like
yeah,
going
different.
back to, I don't trust these companies. I think they have earned my lack of trust. They've earned my skepticism. And I mean, we don't even have enough time, but like, how the hell do I have a second reconciliation issue? Like,
Yeah.
like at its core, these non-depository financial companies and the depository financial companies need to maintain a ledger. Why are we having these ledgering issues? How is it acceptable for these innovative companies to have massive reconciliation issues? And then I kind of connect it to, and like, again, we're running out of time, but to think that the FDIC still doesn't know when it goes into a bank failure who the accounts belong to. And it has its own, like, it has to go through the ledger of the bank itself, and it can pay out most claims. Like, most
Yeah.
deposits are insured, and that's very easy to just move over. But like, this is a problem. This is a wicked problem that our financial is like only, I think, going to become worse in our financial industry. And every time I see it, I get like emotionally reactive to how is it acceptable that we have this ledger issue
S-
at its
So,
core?
a couple of things to kind of respond to what you said.
Yeah.
One is, let's not lump like every new charter applicant, they're not all bad just because they're new. Okay. And you know this, right? But it doesn't mean that we need to
Trust but
instantly
verify over here. I'll
trust
be
but verify.
skeptical.
It
I'll
doesn't
be
mean that we
skeptical.
automatically trust you. Maybe I'll trust you enough to kind of go down the road with you, but I still need to see some reconciliation throughout time, or I need to see some operational kind of nuance and kind of dexterity as you grow. I need to see things, right? The world is not what it is 6 months ago, or we're living in a snapshot in time, and that snapshot changes.
Sure.
That's okay, right? But what you're suggesting, what you're saying is a very important thing. It's something that it's hard for regulators, and they don't have time and they don't have the resources to do, let's look at every stinking ledger. Let's
I
reconcile
know.
every regulated entity for every product they have. That's not necessarily possible. But guess who is that? That is possible for, right? If
Auditors,
you're not
accountants.
mandating reconciliation timelines and processes
Yeah.
into agreements with somebody else who keeps a subledger, you might have an issue, right?
Right.
And you might say, well, gosh, how could Kraken have let $25 million just kind of be unaccounted for? Well, let me give you a little inside baseball. 25 million probably isn't a lot to
It's
Kraken.
not, no, sure.
So,
Sure.
and that's not to say that, oh, too bad on them. No, they have rights and things like that, and they can go after it. But 25 million is not that much. If I were to say, well, should you reconcile an account ledger in which you have $1,000 of customer funds? Oh, $1,000.
I
So where
know.
are we
It's
drawing
probably
this
fine.
line? Where are we drawing the line,
Yeah.
right? And the last thing, and I know we're running up on time, but I want to give you my other, because I have to, it's self-aggrandizing, so I have to say it. I think
Please.
the most important lesson on all these things is what I call the Steffen Principle. I teach it, right? So I teach at Northwestern, have for 7 or 8 years. I teach a class I made up mostly.
Nice.
FinTech and the law, financial and emerging technologies and the law, right? And I always try to teach my students this so they'll spread it into the world. So I'll say
Uh-huh.
it, Steffen Principle.
It's
It's really easy,
manifesting. Go on.
right? It's bad things happen plus money equals lawsuit, right? These are precursors, right? These are the smart contract of the principle. You need money involved and sometimes a lot of money, and you need bad stuff to have happened to precipitate a lawsuit. Otherwise, there is no lawsuit. But anytime those factors are around, you're going to get sued. And here's the other thing, this principle applies more broadly. Who's going to get sued here? Everybody,
Who
right?
takes
You don't
losses? Everyone.
Yeah, throw them all together and
Yeah.
let the powers that be sort them out. But there's a truth in that. You might say, well, what does that matter? Well, remember, Tana doesn't hold.
No,
Who holds the
no,
money?
that money should be at a bank somewhere. We got to just
Yeah,
figure out the bank.
who might get sued? Who might, if
Yeah.
they get around to it,
Yeah.
right?
Well, right?
So you're not safe. And the only way, whether you're providing a service or getting a service as a financial institution to protect yourself, is to do that diligence, to
Right.
look through these things. And that's kind of the scary undercurrent. It hasn't
Right.
happened yet, or I don't know when they're going to start adding new defendants,
Mm-hmm.
but you could see the same claim they raised against the financial kind of CEO and CFO here. They raised aiding and abetting breach of fiduciary duty.
Yep.
Trusts owe fiduciary duties to their customers,
Yeah.
right? But the money is being held at a bank. They liable for such a claim?
I mean, we can't even talk about this, but Metropolitan had to cash out all of Voyager's customers. And
That's right.
that wasn't, I think, even as bad of a situation as this. They were just in bankruptcy and it was an exchange, not a trust. But
That's right.
yeah, I mean,
It's
it made
it's
their
a
life miserable. They got out of crypto afterwards. So
yeah, it's a viable claim and it's a viable risk, right? And that's something that it's why, banking money transmission businesses or banking a trust is a lot more difficult and a lot more risk involved than banking Joe's Chevrolet,
yeah.
right? They are different companies and different risk profiles, and there's a different prospect of you getting drawn into their nonsense, right?
Well, Justin, thank you so much for explaining how lawsuit equals podcast content. I appreciate you bringing me this story, and I'll definitely keep up with it as there's more crypto shenanigans and more of these companies get charters and permission and into the supervised financial space.
Yeah, no, it's fun. I appreciate you having me on. Love talking about this. Always happy to talk about kind of portents of doom. All
All right, have a great rest of your day.
right, bye, Kia.